Morning, everybody, and welcome to Moneycorp's Market Pulse webinar for December. I'm Neil Parker. I'm going to be your host today. I'm head of economics and market strategy here at Moneycorp, and I'm delighted to be joining with you. So, December, the holiday season, being now in full flow, the markets are no less active. We've certainly had an awful lot over the course of the last month or so to discuss. Today, we'll be covering the global outlook, including how things are affecting North America, Europe, and also interest rate decisions across all of those. We'll also take a little look at Mexico for those of you interested. During the session, we're going to basically ban your use of audio or video, so we won't see you. If you want to post questions, however, you can do that in the Q&A box. And we'd encourage you to do that throughout the session, and I'll try and get through as many of them at the very end. But without further ado, we're going to move on to the slides. And first and foremost, look at growth and how things are going there. Well, globally, it looks as if things will be slowing into 2026 versus 2025. There are a number of factors behind that. The first to highlight is that the expectation is that both China and India will see growth slowing in 2026 versus their 2025 outturns. And equally, you're liable to see a quite sharp slowdown in Japanese economic activity. And so even if there wasn't a weakening in those, you would still require some substantial pickup in the likes of the US, the UK, and the Euro area, and we're not really expecting to see that either. So overall, growth is going to be weaker, and that's in spite of the fact that if we look back to the beginning of this year, then what we've seen is that monetary policy has loosened. So you've seen some significant stimulus from central banks, not the least of which we saw only last week from the US Federal Reserve reducing interest rates again. So that disappointment will continue into 2026, but one would anticipate that we'll see an improvement in economic growth into 2027. So it's a temporary slowdown before things pick back up. I think there are quite a lot of questions, however, for the euro area to answer, and particularly the European Central Bank, because they've cut interest rates most aggressively of all the major central banks, more than halving where rates were in 2024, and yet there hasn't really been that improvement. We're still waiting for that improvement. You could probably say the same thing about Canada, but at least as far as their labour market is concerned, we have seen some pickup in labour demand in recent months. The same can't be said of the euro area. So there are big questions to answer there. And given that we've just had their central bank meeting and they seem to be perfectly happy with how things are going, I'm personally not convinced. If we look at other economies, one of the things that I've been encouraged by recently are signs that Brazil has broken the back of its inflation problem. Inflation is trending lower. So I would be very surprised if we don't see some substantial and significant interest rate cuts and monetary policy loosening from the Brazilian central bank over the course of 2026. Looking at those interest rates, this really highlights what I was saying. You've got US interest rates moving lower, euro area interest rates having already moved lower. We've seen a peak in Brazilian rates, but we're not expecting any further increase in Brazilian interest rates. And then the outlier is the Bank of Japan, because the Bank of Japan are the only ones who seem at the moment to be raising interest rates. Now they're raising interest rates because they've got a short to medium term problem with inflation. And I would expect to see when they decide early tomorrow morning that they will be raising interest rates by a quarter of a percentage point. And that will take rates to their highest level in decades, but that's really not hard when you consider that their interest rates have basically been at zero for the last sort of 20, 25 years. Later on this evening, you've got Banxico the Mexican Central Bank, and they're expected to reduce interest rates in line with what we saw from the Federal Reserve. So a 25 basis point reduction there. I think there is more room for maneuver for the Mexican Central Bank to reduce interest rates into 2026. Two reasons behind that. One is that they'll be following suit with the Federal Reserve, but the second is that we've seen over the past 2 months or so some significant strengthening in the Mexican peso, and I think both of those things will be helpful in terms of reducing Mexican interest rates. Now, if we look at the US, and I've been highlighting this for a while, I think one of their biggest problems is the housing market, or rather, the lack of activity in the housing market. So whilst things have improved, demand for mortgages, demand for existing and new homes, all have been subdued versus where they were pre the COVID pandemic. Now, some of that is down to higher interest rates, but some of that, I think, is also down to the squeeze on household disposable incomes. So we'll wait and see whether the latest interest rate cut will have a positive impact as far as the US housing market is concerned, but I'm not convinced that it will. And then there are problems within the US labour market as well, where we've seen a steady upward creep in the unemployment rate. And the recent demand levels, the recent hiring rates that we've seen in non-farm payrolls suggest that employers are being far more cautious about their plans for hiring over the course of this year and next. But I do think that as far as the US is concerned, that lower rates will eventually be positive in terms of improving consumer spending outturns and improving investment. But we may have to wait until 2027 before we see the full impact of those interest rate cuts on those areas. And if we look at Canada, I've mentioned about the improvement that we've seen in the labour market. Now, the long-term chart certainly doesn't give us much clues because you've got those big swings pre and post-pandemic. But then you've also got a zoomed in chart with regard to the right hand side. And what that shows is actually that there has been some steady improvement in both full and part-time hiring over the course of 2025. So even though 4 out of the last 5 months has seen employment levels in full-time employment at least falling, we have seen some steady progress. So overall full-time employment is around 77,000 higher than it was at the beginning of the year. Part-time employment is even stronger than that. So it's roughly double, greater than 140,000. So there have been some improvements in the labour markets, and I think that's one of the strongest reasons why the Bank of Canada has been sat on its hands for a while. I don't think that there's a huge amount to spur the Bank of Canada in the short term into reducing interest rates further. But I would say that if you look at the inflation numbers out of Canada, they're still very well anchored around the 2% target. And consequently, I do think that if there are risks, it's that inflation subsides even further, perhaps falling below that 2% target level, and to levels that as far as the situation with regard to Canadian interest rates are concerned, will see at least one additional cut, and they may be compelled to do that if the Canadian dollar strengthens further from where it has done recently, and also if inflation was undershooting and the Federal Reserve were cutting on their side as well. So there's a lot of potential moving parts there that could still create conditions where the Bank of Canada feel compelled to cut. Now, you may not know this, I'll tell you anyway, but when the UK Labour government in 1997 came to power, there was a song around at the time by a band called D-Ream saying things can only get better. For the Euro area, it's when or if things will get better, because given the amount of monetary loosening and the fact that you are seeing now some of the major fiscal authorities trying to pump money into their economy, it is quite surprising that growth rates are as slow as they are. So whilst the euro area is expected to see an improvement, and the European Central Bank said as much in their last meeting of the year, they said that they'd expect growth to be somewhat faster than they were previously predicting. Inflation might be slightly higher in certainly 2026 than they were previously suggesting. I still think there's a big question here. Why isn't growth better in the euro area? Now, many will blame sort of uncertainty over geopolitics, so particularly things like Ukraine and Russia. Many may well be also blaming the introduction of tariffs on April the 2nd by the US on a whole host of economies and subset commodities. But realistically, surely, given that 85% of trade in the euro area is internal, then the effects of those ought to have been limited. So where's the domestic recovery? And I think that's a question that will become ever louder from the media and also from the financial markets if we don't see a pickup in Q1, Q2 of 2026. And if we look at FX forecasts, well, I know that I've mentioned about the strengthening Mexican peso. Ultimately, I think that may well reverse. I think that the markets may well be overestimating the number of rate cuts that are coming from the Federal Reserve. And if anything explained that or demonstrated that, it was the fact that the split between the Federal Reserve this time around, where there were 3 dissenting votes, 2 voting for no change and 1 voting for a 50 basis point cut, versus the other 9 that voted for a 25 basis point cut. And the fact that 4 of those that actually voted for the 25 basis point cut expressed concern, or at least that they were reticent about delivering that, means that anybody that takes over at the Federal Reserve might find it hard to deliver additional monetary loosening from a unanimous standpoint. So I do think that perhaps for a lot of currencies, whether it's euro dollar, dollar CAD, or dollar MEX, the prospects for additional dollar weakness might have already been overpriced. The only currency that I'm more optimistic about against the US dollar is the Japanese yen, but I have to say my track record on this one isn't great, because I've constantly said this and I've constantly been wrong. But I do think there are reasons to be more positive about the Japanese yen. At the moment, it is certainly being weakened by geopolitical factors in the region. So there has been a worsening in diplomatic relations between China and Japan. Equally, the headwinds that Japan has faced in the short term over the pickup in inflation have been problematic. And I think that fiscal policy still creates a bit of an issue for the Japanese, given how high debt levels are in Japan as a percentage of GDP. But there could potentially be some good news on the horizon in terms of an improvement in geopolitical relations and the calming of some of the noise around the relationship between China and Japan. Energy prices are coming lower, and that ought to be helpful in bringing down the rate of inflation in Japan. And I think that there will be a further series of interest rate increases, which will narrow the gap between US and Japanese interest rates in Japan's favor. I think as far as Canadian dollar is concerned, we have seen some strengthening in the Canadian dollar, but overall, the Canadian economy still continues to materially underperform that of the US's. And over time, I think that will play a part in pushing dollar Canada back above 140 and up towards sort of 144, maybe even 145. Further factor here, from my perspective, is that the Canadian political situation has been mired in controversy between the likes of the Quebec region and the US, with some ill-judged advertisements that were published a few months ago. And so they may well not benefit from any improvement in trade relationships like other nearby neighbors. And then finally, if we look at euro dollar, I do think that we may see some slippage there, because the markets are saying there's virtually no chance of further interest rate cuts from the European Central Bank. And we saw a similar picture being painted by ECB President Christine Lagarde at the press conference today. But that doesn't make any sense to me. I mean, their growth rate is still weak. They've still got problems with regard to domestic demand. They've got a whole host of problems that have been created by a legislative agenda that points to further pressure on their core industries, particularly automotive. And consequently, I think that we may see some slippage in the euro's valuation against the US dollar the longer into 2026 that we run. I think that's where I'm going to stop the presentation, or the formal part of the presentation here. But what I would say is, if you've heard anything here that you find of interest, then please do feel free to reach out to your contact. Equally, if you'd like to hear more from us on a daily basis, then if you scan the QR code for the daily economic insights that we produce, then feel free to do that. But I'm pleased to say that we do have a few questions that I'm going to just quickly tackle. So the first question is, does the recent US consumer price inflation release materially impact future interest rate decisions in 2026? It was interesting in terms of, I thought it might do, because it was a much bigger move in inflation than anybody was predicting. Headline rates fell from 3.1% to 2.7%. The core rate of inflation fell from 3% to 2.6%. And yet the market effect of this was relatively muted. And so I'm a bit surprised by that, if I'm being honest. Overall, there's an old expression, which is one swallow doesn't make a summer. And so perhaps the markets are looking for further confirmation that the trend in inflation is downward, and this isn't a sort of one-off impact. But if we were to get further confirmation from the January CPI figures, which relate to the December period, then I think that could materially increase the chances of short-term rate cuts. I don't think it would necessarily mean that the trough in interest rates would be lower, but the period over which we would approach that low in US interest rates could be shorter. So yes, it does have an impact, and it could be short term. Could mean, short term, the dollar would be weaker. But overall, in the longer term, I do think that there are other problems that the markets might be glossing over with regard to the likes of the Eurozone economy, with the likes to the Canadian economy, and also other economies around the region, that ultimately could mean that the dollar bounces back far quicker and far more strongly than is currently anticipated. Second question is, has the situation with dollar Canada changed in light of the recent labour market data? I did refer to this in one of the slides, but I think the markets are perhaps still interpreting a lot of this data from a two sort of medium-term perspective. Yes, there has been some improvement in the Canadian labour markets, but we haven't seen any transference of that into faster rates of economic activity. Until we do, weak domestic demand growth is probably a much bigger factor at play with regard to future Bank of Canada decisions than the short-term labour market moves. I still think that there's a chance, probably a much higher chance than the market's price for, because they don't believe that there is a chance the Bank of Canada will cut interest rates again. And were that to come about, were that to be made more obvious to financial markets, then you could easily see quite a swift and quite violent correction in dollar Canada higher. So I don't think that these few months worth of data, with some distortions in them, ought to be overplayed as far as the dollar Canada exchange rate is concerned. In terms of another question, it's, do you think that the US position on tariffs will soften in 2026? This can be quite controversial, because ultimately the US's position on tariffs is perhaps inextricably linked to another position that the US administration has, which is about giving households a fairly sizable tax rebate check of either between $1,000 or $2,000. So unless they were to change that, I'm not sure that they can alter their position on tariffs unless there were a material improvement in economic growth, because that would undoubtedly help to boost underlying tax revenues and perhaps create the headroom for those checks to be cut without having to apply additional tariffs. But tariffs don't appear to be going away anytime soon. as far as the US administration is concerned. I certainly wouldn't expect them to. And even if there is an adverse ruling in the US Supreme Court, I would anticipate that the administration would likely look at how they could repackage and repurpose the tariffs, perhaps going down the commodity route or individual product route, rather than looking at this on a country by country basis. So I don't think that we'll see a particular softening in tariffs in 2026. I look forward to being proven wrong on that, but I don't think that we will be. It doesn't look like we have any further questions at this moment. So on that note, and hopefully you've enjoyed what you've heard today. Thanks very much for joining us and for your attention. I hope you found the session useful. If you have, please recommend it to your colleagues or other clients that you might have. I'm going to keep running these sessions each month. So please make sure you subscribe to our Market Pulse, because then you'll get the first update of when the January session will be. And the Market Pulse is, of course, our market economic commentary on a daily basis. We'll share the recording with you very shortly. And also, if you'd like these slides, then do make sure that you reach out to your regular contact within the Moneycorp business. Finally, you're going to receive a short survey, and that will effectively provide us with feedback about the content of the slides that you've had today. If you can spare 5 minutes, that'd be fantastic. Just to give us some idea of what you'd like to hear more about, what you'd like to hear less about, or what you'd like to hear nothing about. Please do spare us the time. Even if you want to tell us how you're doing, how your circumstances perhaps differ from what you've heard today, then I'd be really, really pleased to receive that. So it just leaves me to say thank you very much for joining us today. We've enjoyed presenting these over the course of the last quarter, and we look forward to seeing you again in the first quarter of 2026. But for now, thanks very much and goodbye.